There's a powerful planning technique that can help you lower your taxes in any one given year that's super easy to use and very flexible. And it's a tool that probably makes sense for most families, but a lot of people don't know about it. So take a walk with me and let's talk about this. So the tool I'm talking about is what's called a donor advised fund. And what a donor advised fund is, it's an account with your custodian. And by custodian, I just mean where your investment account is held, like at a Schwab or a Fidelity. It's an account at a custodian where you can make a charitable donation in 1 year, but you don't, and it qualifies on your taxes for making that donation, but you don't have to decide the ultimate charity that's going to get those proceeds. And the ultimate charity doesn't have to get all of the proceeds that you put in. You can write it, typically you can have a check written for as little as $100 to various charities. So it tends to be a really powerful tool, and you can donate appreciated securities, a stock. Let's say you bought Apple stock 5 years ago and it's doubled in value. If you were to sell that Apple stock, you'd likely have to pay capital gains tax on that, and then you would have the after-tax money. But if you donate that stock to a charity, which a donor advised fund qualifies as a charity, if you donate that, you don't have to pay the tax on it. The charity would have to pay the tax on it when they sell it, which they're going to do right away. But because they're a charity, they don't pay taxes. So it's a really powerful tool. It can extend how much money that you ultimately get, because you essentially are donating pre-tax dollars, and then really nobody pays the taxes on it. So it's powerful in that way. And it's also powerful because you can put the money in, and it's not like you have to actually decide on the ultimate charity in the same calendar year. You don't have to. You can keep it in the donor advised fund for a decade if you want. You can have subsequent advisors on your donor advised fund. It can be your children. And actually, if you already have a donor advised fund, I really encourage you to check with the custodian where it's at and make sure you have what's called a subsequent advisor. And what that means is when you pass, if you don't have a subsequent advisor, the custodian's charity is going to make the investment decisions and the ultimate decision as to where that money goes. And for many of us, we want our kids to be able to do that, right? Or somebody that we have a relationship with. We want them to be able to support the organizations that they care about. So make sure that you have what's called the subsequent advisor designation with your custodian, so it doesn't just go to the custodian's charity. So again, it's a powerful technique. Let's say, I'm going to give you an example now. Let's say you have a stock that's done well. Let's go with Apple. Apple's actually down this year. But let's say you have a position that's done really well. You want to donate. You don't want to pay tax on that, so you can donate this to a donor advised fund. This is not an endorsement, but my personal donor advised fund is at Charles Schwab. It's super easy to use. This is not a sponsored video. I wish it was, but it's not. They do have a good tool. I know Fidelity is really the one that pioneered this idea. So Fidelity has a good donor advised fund option as well. So let's say you have this appreciated stock rather than pay tax on it. And let's say you do have a charitable intent. There's organizations you like to support, and you know you want to support them in the future. And let's also say that you're in a fairly high tax bracket this year, which is really where it's powerful. If it makes sense for you to itemize your donations that you make, what you can actually do is, and for a lot of people it makes sense because of the current tax law, to actually combine several years worth of donations into one calendar year, so you get the maximum tax benefit. Now, I'm not an accountant, and I encourage you to work with an accountant. This is not tax advice. This is not financial advice. This is educational advice. I want you to know about this tool so you can do research on your own and decide if this is the right tool for you and your family. And if you want to work with a fee-only financial advisor, I just suggest that you Google that term, and work with one near you. Okay, so getting back to this example, you have this appreciated asset, you happen to find yourself in a higher tax bracket year, what you can do is you can actually donate that position to the donor advised fund at the custodian of your choice. They're going to sell that position likely as soon as they get it. But then you can also choose how they invest that money. Typically, they don't have as many choices as you might have like in your IRA or something like that, but they do have a pretty good selection of investment choices. So you can get 100% exposure to the U.S. stock market or international markets, just high-level asset allocation tools like that. And then you can let that money grow over time. And let's say there's an organization that you support and you want to write, just for simplicity and to show you how convenient it can be, you want to support a group and send them $100, which I think is the minimum donation that you can make. Well, this custodian that has their own charity, that's how you originally got your tax deduction. Now you can advise that charity on where you want that donation to go ultimately. And it's donor advised because they're not legally obligated to send that money to that charity, but their business is going to be short-lived if they don't. And generally the criteria is, as long as it's a recognized charity by U.S. tax authorities, which tends to be a 501c3, as long as it's a generally recognized charity, then you can make a donation to that. So that's how it works. It's super simple. And then again, I said, you can actually put multiple years worth of donations in there. And for many people, that is one way to maximize the tax benefit. Again, talk to your accountant about it. Make sure that that's the case for you as well. But it's super convenient. You just get a normal statement like you would for your IRA account or your taxable investment account. And there's really not many downsides other than once you make that donation, that then becomes an asset of that custodian's charity. You can advise on it. But if you said, hey, gee, I want you to pay my kid's tuition with this, that's going to be something that they're going to say, I'm sorry, we're not able to do that. So there's very few downsides. I think it's one of the most powerful tools for how simple and easy and convenient it is. And it's a shame that more people don't know about this. So if you'd like me to do a deeper dive on donor advised funds, let me know. I'm happy to do that. Just let me know in the comments. In general, I try to take a really high level approach on this channel. But let me know in the comments what you thought of this video, what you'd like to see in future videos. Do hit the like button. Please take a second and hit the like button. It really does tell the algorithm that this is a good video and it can help other people, and it helps other people find my channel. And until next time, I'm Azul, encouraging you to take life to the fullest and squeeze all the juice out of it. Remember, if you're approaching 60, you only have 1,000 weeks left, likely, of healthy, active time in front of you. So take full advantage of the youth of your senior years while you still can. Remember, you're only young once. Bye.